Recession is a word that stirs fear into even the most seasoned investors. It brings to mind plummeting stock prices, soaring unemployment, and relentless economic uncertainty. But what if I told you that a recession isn't just a time to survive, it's a time to thrive? What if instead of retreating you positioned your portfolio to grow, even as the economy contracts? In this video, I'm going to walk you through 5 ETFs that are built for resilience. These aren't just popular picks. They're backed by data, history, and smart strategy. Whether you're new to investing or looking to optimize your long-term game plan, you'll want to stick around. I've personally held some of these during volatile markets, and they've done more than just survive. They've kept my portfolio strong. So, let's break down each ETF, why it works in a recession, and how you can use it to build a bulletproof investment strategy. Before we jump into the ETFs, let's talk about what actually works in a recession. Historically, recessions are marked by falling GDP, lower consumer spending, rising unemployment, and declining business investment. That's the bad news. But the good news is that certain sectors and investment styles consistently hold up, or even perform better, during these times. Here's what we're looking for: low volatility, assets that don't swing wildly in value, essential services, companies that people rely on no matter the economic climate, strong dividends, income-generating stocks that keep paying even when growth slows, defensive sectors like healthcare, utilities, and consumer staples, treasuries and bonds. These offer a safe haven when stocks fall. With that context in mind, let's get into the 5 ETFs I'd consider recession-ready. Let's start with the foundation of many long-term portfolios, VEO, the Vanguard S and P500 ETF. Now you might think, why would I invest in a broad market ETF during a recession? Isn't the whole market falling? Yes, but here's the nuance. VOO gives you access to 500 of the most profitable and well-established companies in America. And during downturns, those mega-cap companies like Apple, Microsoft, Johnson & Johnson, and Procter & Gamble tend to hold up far better than speculative small caps. Historical data backs this up. During the 2008 financial crisis, the S&P 500 fell sharply, but it also recovered faster than many sectors, and those who continued dollar-cost averaging into it saw massive gains when the recovery began. I've used VEO as a core holding for years. Even in choppy waters, it offers diversification and resilience. Think of it as your economic anchor. It won't always soar, but it'll keep your ship steady. Next up is a personal favorite of many income-focused investors, SCHD. This ETF is built around high-quality U.S. companies that consistently pay and grow their dividends. Why does this matter during a recession? Because when growth stocks are plummeting and companies are tightening their belts, dividend-paying companies offer a lifeline. SCHD focuses on firms with strong balance sheets and a history of weathering economic storms. Think Coca-Cola, PepsiCo, Verizon, companies that generate cash and keep rewarding shareholders even in tough times. In 2020, while the broader market was in freefall, SCHD's price drop was relatively modest. And even more importantly, it kept paying dividends. That income can make a huge psychological difference, especially when everything else feels like it's falling apart. If you're aiming for both stability and cash flow, SCHD belongs in your recession toolkit. Ever notice how no matter how bad things get, people still buy toilet paper, toothpaste, and cereal? That's the logic behind XLP, which focuses on consumer staples, the products we can't stop buying, recession or not. This ETF includes companies like Procter & Gamble, Walmart, and PepsiCo. During downturns, these companies experience less demand disruption. After all, even if you cancel your Netflix subscription, you're still brushing your teeth. Historically, XLP has been a defensive powerhouse. In the 2000 dot-com bust and the 2008 crisis, it outperformed the broader market by wide margins. In 2020, it again held strong, dropping less and rebounding quickly. If you want to shelter your portfolio from the worst of a recession, XLP acts like a shield, protecting your capital while the market takes hits. Stocks aren't the only game in town. During recessions, bonds, especially U.S. Treasuries, shine as investors flee to safety. And IEF, which targets intermediate-term treasuries, is one of the best ways to access this part of the market. Why intermediate term? Because short-term bonds offer less yield, and long-term bonds are more volatile. IEF strikes a balance, offering reasonable returns with limited risk. In 2008, while equities crashed, Treasury bonds surged. In 2020, IEF again proved its worth. It's not flashy, but when markets are bleeding red, holding something that's green feels like gold. I keep a slice of my portfolio in treasuries for precisely this reason. They're my insurance policy. When the storm hits, they soften the blow. Now this one might surprise you. Tech in a recession? Really? Yes. VGT isn't just any tech fund. It's loaded with high-margin, cash-rich companies like Apple, Microsoft, and Nvidia. These aren't speculative plays. They're the backbone of the digital economy, and many of them actually benefit from economic shifts. Case in point. In the early days of the 2020 pandemic, cloud computing, remote work, and digital infrastructure exploded in demand. VGT dipped initially, but then skyrocketed as investors realized that tech wasn't going anywhere. Recessions often accelerate innovation. Companies streamline operations, adopt new technologies, and consumers change habits permanently. That's fertile ground for the right kind of tech companies. VGT is a way to tap into the winners, those that don't just survive recessions but come out stronger. Let's say you're building a portfolio with recession resilience in mind. You want protection, income, and the potential to grow. A balanced mix might look like this: VO 30% for broad market exposure and long-term stability, SCHD 25% for consistent dividends and strong fundamentals, XLP 15% for defensive sector protection, IEF 20% for bond-based risk reduction, VGT 10% for growth and future upside. This isn't a magic formula, but it is a blueprint based on history, logic, and risk-adjusted return. During the 2020 recession, I didn't panic. I rebalanced. I leaned into SCHD for income, added more IEF for stability, and didn't touch my VGT and VOO holdings. When the recovery came, I was in prime position. What matters is mindset. Recessions aren't the time to abandon your strategy, they're the time to refine it. These ETFs give you the tools to do that without guessing, stressing, or chasing trends. No one knows when the next recession will hit, but we do know it will hit. The question is, will you be prepared? With the right ETFs, you can turn a downturn into an opportunity. These 5 picks, VUO, SCHD, XLP, IF, and VGT, offer a mix of safety, income, and long-term upside. They're not hype, they're not speculation, they're strategy. If you found this helpful, consider subscribing. I'll be sharing more deep dives like this, portfolio breakdowns, ETF analysis, and investing strategies designed for real-life investors like you. Stay sharp, stay invested, and remember, in every crisis lies opportunity.